Hello, welcome back. If you're a first-time buyer, or even if you're looking to upgrade and leverage a bit more than you have in the bank, you have definitely heard the whispers. You've walked into a mortgage broker's office where you've been scrolling through real estate listings at 11 p.m. on a Tuesday, and you hit this wall. It's a term that sounds incredibly boring, but can cost you the price of a small car. I'm talking, of course, about LMI, lender's mortgage insurance. Now, stepping into the property market can feel like learning a completely new language. You got LVRs, offset accounts, fixed versus variable, and then this beast, LMI. It floats around in conversations, usually accompanied by a groan or a sigh. But here's the thing. A lot of people fear it because they don't understand it. Today, we're going to demystify it. We're going to break down exactly what it is, how it affects your journey, and the part you're all waiting for, how you might be able to ghost it completely and avoid paying a cent. Segment 1. The Great Misconception. Let's start with the basics because there is a massive misconception right at the starting line. When you hear insurance, what do you think of? You think of car insurance, health insurance, home and contents insurance. You think of a product that you pay for, which protects you when things go wrong. Well, lender's mortgage insurance is the exception to that rule. It is essentially a safety net. Yes. But here's the twist that catches everyone off guard. It is not there to protect you. If you lose your job, or you get sick, or the economy tanks and you can't make your mortgage repayments, LMI does absolutely nothing for you. Instead, lender's mortgage insurance is designed entirely to protect the lender, the bank, if you default on your loan and the property is sold for less than what you owe. Think of it this way. It is the bank's insurance policy. It lowers their risk. But in a cruel twist of financial fate, you are the one who has to pay the premium. It feels a bit unfair, doesn't it? You're paying to protect the bank from yourself. But without it, the banks simply wouldn't lend money to people who don't have a massive stack of cash sitting in their savings account. Segment 2. The magic number and the cost. So when does this kick in? When you have to swallow this pill. The magic number you need to tattoo on your brain is 20%. In the eyes of an Australian lender, the world is divided into two types of borrowers, those with a 20% deposit and those without. If you're borrowing more than 80% of the property's value, meaning your deposit is less than 20%, you're almost certainly going to get hit with lender's mortgage insurance. Why 20%? It's not just an arbitrary number pulled out of a hat. Lenders look at historical data, and they see that loans with smaller deposits are higher risk. From their perspective, if you haven't managed to save a substantial deposit, statistically, you might be more likely to face financial difficulties down the track. Or, if the property market dips, a small deposit means you have less equity buffer before you own more than a house is worth. Now, let's talk dollars and cents. Because this isn't just about a few $100. The cost of LMI in Australia can range from a few $1,000s to tens of thousands. It depends heavily on your loan amount and your deposit size. Let me give you a concrete example to anchor this. Let's say you are looking to buy a property worth $600,000. Not a mansion, just a standard starter home in many parts of Australia. If you have a 10% deposit, that's $60,000. You're borrowing the other 90%. In this scenario, you could easily be facing an LMI bill of over $10,000. Stop and think about that for a second. $10,000. That is a significant chunk of money. That is money that could have gone towards new furniture. It could have paid for a kitchen renovation. It could have just sat in your offset account as a buffer for when the hot water system inevitably blows up the week you move in. Instead, it vanishes into the ether to insure the bank. And the reality is tough. If you are eyeing a property worth $500,000, to avoid this fee entirely, you need a $100,000 deposit. For many first-time buyers, especially in the current cost of living crisis, saving that amount while paying sky-high rent and managing daily expenses. Honestly, it can feel like climbing Mount Everest. Segment 3. The hidden multiplier capitalization. But wait, it gets worse. And I promise I will get to the good news and the strategies soon. But you need to understand the trap before you can avoid it. There is a feature of LMI that banks frame as a convenience, but it can be a silent wealth killer. It's called capitalization. What many first home buyers don't realize is that you don't necessarily have to pay this $10,000 or $15,000 upfront in cash. The banks allow lenders' mortgage insurance to be capitalized into your loan. This means they add the fee on top of your mortgage balance. So, using our previous example, you borrow $540,000. The LMI is $10,000. The bank says, "Don't worry, we'll just make your loan $550,000. Initially, this feels like a massive relief. You don't have to scrape together that extra cash right now. But remember, once it is added to your loan, you're paying interest on it. And not just for a year, for the life of your loan, which is typically 30 years. If you run the math, that $10,000 premium sitting in your mortgage at an average interest rate over 30 years could end up costing you $20,000 or more by the time you pay it off. You are effectively paying double for an insurance policy that doesn't even protect you. This is why understanding LMI is crucial for your property finance strategy. Segment 4. The variables. Before we move to avoidance strategies, we need to touch on the fact that not all LMI is created equal. The actual cost varies significantly based on a few factors. The biggest driver is your loan-to-value ratio, or LVR. It's a sliding scale of pain. A 95% LVR, where you only have a 5% deposit, will cost considerably more than an 85% LVR. The risk grows exponentially as the deposit shrinks, and so does the premium. But here is a curveball. Your employment type matters too. If you are a permanent full-time employee, you are the golden child to the banks. But if you are self-employed or a contract worker, you are viewed as riskier. Consequently, you might face higher premiums than someone in permanent full-time employment, or you might find it harder to get approval for LMI at all. Segment 5. Smart strategies to avoid LMI. Okay, take a deep breath. That was the doom and gloom part. Now let's flip the script. Before you resign yourself to paying this lazy tax, let's explore some clever ways to sidestep this extra cost. Obviously, the most straightforward approach is saving that 20% deposit. But as we discussed, we know that is easier said than done in today's market. Telling someone to just save more when rent is $600 a week is not helpful advice. So, let's look at the creative solutions. Strategy number 1, the government handshake. First home buyer schemes across Australia can be your absolute secret weapon here. The federal government has realized that the deposit hurdle is too high for many, so they introduced the First Home Guarantee Scheme. This is a game changer. It allows eligible buyers to purchase a home with as little as a 5% deposit without paying lender's mortgage insurance. How? The government acts as a guarantor for up to 15% of your loan. They aren't giving you cash, but they're telling the bank, "Hey, we've got this person's back for that missing chunk of deposit." The bank sees the risk is covered, so they waive the LMI. It's not just federal, either. Each state has its own initiatives. For example, if you're listening from South Australia, look into the Home Start Finance program. They offer similar benefits to help locals enter the property market sooner. If you're a first home buyer, your very first step should be checking your eligibility for these schemes. It can literally save you $15,000 overnight. Strategy number 2, the bank of mom and dad. If you don't qualify for government schemes, maybe you earn too much, or you've owned property before, there is another option. Having a family member act as a guarantor for your loan. This is often called a family pledge loan. Essentially, your parents usually offer the equity in their own home as additional security for your loan. So, you put up your 5% cash. Your parents put up 15% worth of equity from their house as security. The bank looks at the total security 20% and says, "Great, no LMI required." This would be a fantastic way to get in, and this is a huge but, it comes with risks. If you default, the bank can come after your parents' house. It is crucial that both parties understand the risks involved and seek independent legal advice before proceeding. It makes Christmas dinner very awkward if you stop paying your mortgage and the bank sends a letter to your mom. Strategy number 3, the professional perk. Now, here's something that might surprise you, and it's one of the best kept secrets in the industry. Certain professions can access LMI waivers even with deposits as low as 5% or 10%. This is known as a Medico pack or professional pack. If you're a medical professional, a doctor, dentist, surgeon, or a lawyer, accountant, or work in select other fields like mining engineering, depending on the bank, many lenders offer special packages that waive LMI requirements completely. Why? It's not because banks are charitable. It's because their data shows that people in these careers typically have stable, high incomes and represent a much lower risk of default. If you were a doctor buying a $1 million home with a 10% deposit, you would normally pay about $20,000 or more in LMI. With a Medico pack, $0. The key here is shopping around and working with a mortgage broker who understands these professional exemptions. Not all lenders offer them, and the qualify criteria can vary significantly between institutions. Sometimes, simply being a member of a specific professional association or having completed specific qualifications is all it takes to unlock these benefits. Segment 6, the counter-argument, paying it strategically. Now, I want to pivot to a slightly controversial opinion. We spent the last 10 minutes talking about how to avoid LMI, but sometimes the smartest move is actually to pay it. This is about timing your purchase strategically. We often get stuck in the mindset of minimizing fees, but we forget about opportunity cost. If property prices in your target area are rising rapidly, waiting 2 years to save that full 20% deposit might actually cost you more in the long run than the LMI bill would have. It is about finding the right balance between minimizing costs and seizing opportunities. Let's run a scenario. Imagine you have a 10% deposit saved right now. You could buy today, but you'd have to pay $10,000 in LMI. Or you could decide to wait another year to save the other 10% to reach that magical 20% figure. But what happens if the market moves? If property prices increase by just 5% during that year on a $500,000 property, the house is now worth $525,000. That is a $25,000 price hike. So you saved $10,000 by avoiding LMI, but you lost $25,000 because the house got more expensive. In this case, the additional amount you need to save outweighs the lender's mortgage insurance cost. Plus, by buying now, you're in the market. You get that capital growth yourself. You wouldn't miss out on a year of building equity in your own home rather than paying someone else's mortgage through rent. So, don't view LMI purely as waste. Sometimes it's the cost of entry to get onto the ladder before the ladder gets pulled up higher. Segment 7. Making LMI work for you. If you run the numbers and decide, okay, I'm going to bite the bullet and pay the LMI, there are still ways to optimize the situation. You can make lenders' mortgage insurance work for you, or at least minimize the sting. Firstly, ask your broker about LMI refunds. This is rare, but some lenders offer partial LMI refunds if you pay down your loan to below 80% LVR within a certain time frame, typically 1 to 2 years. How would you do that? Well, if you get a big bonus and make extra repayments, or more likely, if your property value increases significantly in a boom market. If you pay LMI, and the market jumps 20% in 2 years, you might be able to refinance and get a portion of that premium back, depending on the lender's policy. Secondly, shopping around for the best home loan rate becomes even more critical when you're paying LMI. If you're adding a cost to your loan, you want to ensure the interest rate on that loan is as sharp as possible. A slightly lower interest rate can help offset the LMI cost over time. For example, if lender A charges $8,000 LMI but has a 6.5% interest rate, and lender B charges $10,000 LMI but has a 6% interest rate, lender B might actually be cheaper in the long run despite the higher insurance premium. Don't just accept the first offer. Use mortgage brokers, compare rates online, and don't be afraid to negotiate with lenders. Segment 8. Conclusion and next steps. As we wrap up today's deep dive, I want you to remember that understanding lenders' mortgage insurance is just one piece of the home buying puzzle. But it is an incredibly important one that can significantly impact your property finance journey. There is no one-size-fits-all answer here. For some of you, the right move is to hustle, live on instant noodles, and save that 20% deposit. For others, it's using the first home guarantee. And for some, it's accepting the LMI cost to get into a rising market today. Whether you choose to save for a larger deposit, explore government schemes, or move forward with LMI, The key is making an informed decision that aligns with your personal circumstances and long-term goals. Buying your first home is a marathon, not a sprint. It can be emotional, stressful, and confusing. But knowledge is your best currency. Take the time to understand all your options. Seek professional advice. Talk to a broker. Talk to a financial advisor, and don't let lender's mortgage insurance become a roadblock to achieving your property dreams. Don't let an acronym scare you out of the market. Analyze it, calculate it, and then defeat it. With the right strategy and support, you can navigate these waters successfully and find yourself holding the keys to your very own home sooner than you might think. Thank you for listening, and I'll catch you next time.